If you had put $10,000 into Nvidia 5 years ago, you'd be sitting on over $120,000 today. $10,000 into Palantir just 3 years ago? That's $30,000 right now. That kind of return isn't luck. It happens when you catch the right product in the right market before everyone else notices. I'm about to show you my actual portfolio, not a mock-up, not a hypothetical screenshot. The real thing, gains and losses included, because this year has been brutal. At one point, I was down over $20,000, and I'm going to walk you through exactly which 9 stocks I'm buying right now to try to come back stronger. A mix of safe value plays and high-risk, high-reward moonshots. If you only watch one investing video this year, watch this one till the end, because stock number 7 is one almost nobody is talking about yet. And I think that's exactly why it's the opportunity. Let's get into it. Show screen recording of brokerage account. This is what real investing looks like. It's not a straight line up. It's volatile. It's stressful, and honestly, most of the gurus you see online never show you the red days. I'm showing you mine because I want you to trust the picks I'm about to give you. Here's the thing about volatility though. Smart investors don't run from it, they use it. When good companies get dragged down with the market, that's often the best entry point you'll get all year. That's exactly the mindset behind my next 9 picks. We'll start with the safer, undervalued big cap plays, then move into the riskier, higher upside bets. Let's start with stock number 1. Our first pick is down significantly over the past year, while its biggest competitors have ripped higher. That's created a real gap between the stock's price and what the actual business is doing. Show stock chart. So, why has it dropped? Some of it comes down to a rough stretch of headlines. Product complaints, AI features that felt more like ads than upgrades, and some public trust issues. That's real. And it matters for the consumer side of the business. But here's what most headlines miss. Amazon's consumer division isn't actually where the growth is anymore. Look at this. Show revenue chart. Cloud enterprise segment. Their enterprise and cloud segment is up 18% year over year. That's the real engine of this company now, and it's barely reflected in the stock price. When I pull up the valuation on Yahoo Finance, this stock is trading at a forward PE of around 40, well below the sector average of 55. That's a meaningful gap. The bet here isn't a 10 times. It's a company priced like it's struggling when the numbers say it's actually pivoting successfully. That's the kind of mismatch I look for in a safe pick. Everyone knows the obvious AI chip winners by now, but there's a company sitting one layer deeper in the stack, the networking and infrastructure layer that connects all those chips together, and the market still hasn't fully priced it in. Show product/infrastructure diagram. This company doesn't get much attention because they don't sell to consumers. They sell to the hyperscalers building data centers. But that also means when AI infrastructure spending grows, this company grows almost automatically, with less hype-driven volatility. 2 catalysts stand out to me. First, their cash position, sitting around $9 billion, gives them room to buy back debt and stay flexible while rates stay elevated. Second, they've been striking infrastructure partnerships that basically guarantee future orders flow back to their own products. It's a self-reinforcing loop, and it's very good for shareholders. Their forward PEG ratio sits around 0.9. Anything under 1 generally signals the market is underpricing future growth. This isn't a moonshot. It's a compounding machine hiding in plain sight. Insert your own sponsor read here. Keep it under 45 seconds, be transparent that it's paid, and place it after a strong segment so retention doesn't drop. Let's shift away from big tech into something more speculative, but a market that's finally hitting commercial maturity, space. Here's a stat that should get your attention. Commercial companies now handle around 70% of all launches, and that number keeps climbing. According to a widely cited industry report, the space economy could be worth over $1.8 trillion annually by 2035. show growth chart. I'm not going to pick individual small cap space stocks here. Too much single company risk. Instead, I like owning the whole ecosystem through an ETF. Think about how the smartphone created an entire app economy on top of it. Space is doing the same thing right now. Rockets are the smartphone, and dozens of companies are building the apps on top. Satellite, communications, in-orbit manufacturing, defense tech. My pick here is ARKX, which holds meaningful exposure to the biggest players in commercial launch and satellite infrastructure, without betting everything on one company. There's also UFO. If you want more defense tech exposure mixed in, just know the holdings and risk profile are noticeably different, so pick based on what you actually believe in. Segment 5, quantum computing. Why now? 7:30 to 9:30. Here's the headline that made me take quantum computing seriously as an actual investment category, not just science fiction. Governments are now putting billions of dollars directly into quantum computing companies. That's not hype money, that's strategic money. Show market growth projection. Chart quantum computing is projected to grow at roughly 30% annually, and the number of quantum startups crossing billion-dollar valuations has been climbing fast. We're finally seeing real commercial use cases in biotech, research, and cybersecurity, not just lab demos. My top pick in this space is IBM, because they're not just building the hardware, they're building the entire ecosystem. Cloud access, developer tools, and enterprise consulting to help companies actually use quantum computing. That full stack approach is exactly what turned cloud computing into $1 trillion category. And I think it plays out the same way here.